right, this is the Cow Guy Close, and I am Scott Schulte, also known as the Cow Guy, and there is an open argument as to how strong this economy really is. The administration and some economists say it's strong and point to the job market as proof. I say it's weak. And to further my case, I want to point to economist Peter Schiff. He's known and respected around the world, and he accurately predicted the 2007 housing crash and subsequent banking crisis. This week, Schiff said not only is a recession already here, but it's not going to be mild. He said it will be worse than 2008, with inflation leading the charge. In fact, Schiff says Americans will have the worst of both worlds, a recession worse than the Great Recession of 2008, and inflation worse than anything we saw in the 1970s. Maybe I'm wrong, but that sounds pretty bad. And if you look back to 2008, the smartest people in the room, including the Fed, were in recession denial. We've already had one negative quarter of growth. I can't explain that away. And the major retailers are signaling job cuts coming around the corner, too. So remember, that's the one area the smartest people in the room are touting in this economic climate. So how can we stop this, and what can the Fed do? Please welcome to the show, Keith Fitz-Gerald, long-lost Keith Fitz-Gerald. Thank you for coming back to us, Keith. I guess that's a good question. What can the Fed do? I mean, you listen to Peter Schiff. Maybe we have what he says, maybe we don't. I think we're definitely going to have a recession. I don't know where you stand on that, but what's the Fed to do?
Well, I think, number one, the Fed has got to acknowledge that it lost the plot a long time ago. Number two, it's got to get back to things that make this company grow. Number three, it's got to stop the spending and take some money off the table. This is about too much money in the system, not too little like everybody thinks. So until that course is right, until the public feels that the Fed, A, gives a rip, and B, is actually in control, the selling is going to continue.
And I think what's changed for me is last week, there was a sea change in my environment because we had some retailers that got caught. They just got caught. They weren't expecting maybe how high prices in the diesel world were going to hit them. And then inventory. I mean, if we start to see some things crack in that area of the world, I mean, look, we've been waiting for some sort of unemployment change because that would be the third leg of this horrible thing we call stagflation. I'm starting to get a little bit concerned about that. Now, we're also supposed to have a growth, a positive growth for the second quarter here, but we're supposed to have a positive growth for the first quarter too. So that doesn't mean that can't change. So as quickly as some of our CEOs got caught with inventory issues and some of this, the other things, could we be caught again when it comes to GDP and how well the economy is doing?
Well, I think that's an excellent question, but respectfully, I'm going to push back a little bit on that one. The CEOs that got caught, Scott, were the CEOs that managed poorly. Everybody and their monkey's uncle out here in the real world that has to live paycheck to paycheck, that has to put food on the table, understands that inflation's real, understands the job market's tough, understand that diesel isn't available. We understand these things. The people who don't are the economists and the Beltway boffins. So this notion, this narrative they've constantly been pushing about things are rosy and we're going to recover is complete poppycock as far as I'm concerned. I think what we've got to do is, again, get the money off the table, get the jobs moving forward seriously, get the employment and the skills lined up. There are lots of jobs available, but the problem is people don't want to put in the effort to get them. They don't want to hit the skills needed. Trades, you can't find a plumber when you need one. Electricians are hard to come by. You can't find a decent carpenter, a diesel mechanic, any of those things, truck drivers, all skills desperately needed in today's environment to fix supply chain issues.
Well, and that's true. And the supply chain, what does the supply chain live on? Diesel fuel. That's another issue we have to worry about. Right. So if it's not one thing, it's another. And I said the other day on one of my hits with Stewart, it's like the game of whack-a-mole. This administration is just hitting the mole back into the hole, and they're popping up elsewhere. Would you agree with the issues and the problems just keep popping up?
I think they're missing the mole entirely. I'm not sure that Carnival Barker would even have them at the game table.
Right.
I mean, it's just an appalling degree of hubris that's coming out of Washington right now on every level. And to me, that's disgusting as an American, because what they ought to be doing, Scott, frankly and bluntly, is they ought to be putting all those differences aside. They ought to be helping the people they serve instead of servicing themselves. All
right, let's talk about one thing I'm worried about, because this happens all the time. They're going to be too transparent at the Fed. They've said what they want to do as far as raising 50 basis points going forward. I think they're going to overshoot, and I think they're going to overshoot and then get caught again with this slowing economy, and they might have overdone it, and that could really be what Peter Schiff is talking about.
Well, I think the Fed has already caused the next 3 crises. I mean, they haven't been right once. So, I frankly, at this point, the notion that we're going to look to the Fed for anything resembling realistic, accurate guidance is just foolish. I think we need to look at the Fed and say, hey, you guys failed. You guys need to fix this. And until you do, you're out of a job. So the markets are going to take, you and I talked at the beginning of the year that if the Fed doesn't do something, the markets would take matters into their own hands. That is what's happening now because they don't believe the Fed any more than you and I do.
All right. So we also had some housing numbers come out today, and the average price of a home went up from, like, say, $432,000 to, say, $450,000, and the pace of which we've seen homes trade back and forth dramatically slowed. But the takeaway is that the housing prices went up again. Is this going to be just a supply issue, or are we going to slowly but surely start to see those prices tail off too?
I think we're not only going to see them tail off, but we're going to see them come down because the buyer concessions, those things are beginning to grow. We're seeing slowing, volume, velocity of the houses moving. To me, it's a natural part of the process as rates rise. You're getting the buyers that moved quickly out of COVID, and then the funds that had money, the folks that came out of LA and bought with pocket change, and the rest of the country driving prices up to unobtainable levels for normal people who already live there. I think that's all going to slow down. It has a way of equalizing. I'm reminded right now of what's happening here of Japan in the early 90s, which I lived through over there. So it's to me, this is shades of gray. We've seen this playbook before. It's going to be ugly. It's going to be tough, but there is going to be a path through it.
That's Shinjuku and Roppongi, if I remember correctly from my days as
exactly.
Well. Okay, so I don't know if we've got you on record, but I say that I think we're going to have a recession. I think it might be a little longer and a little shallower than most folks think. Are you in recession camp or no?
I'm in recession camp. I wasn't until relatively recently when it became unavoidable in my opinion. But to me, we've already been there. So it's a matter of looking onto the other side. The good news in all this, and this is one of these things that's hard to imagine, but once the market price is in a recession, the average uptake is 40%. So if you're an investor and you're buying in, you've got a couple years to deal with here as opposed to needing your capital now, that's actually not a bad thing to think about.
Right, and just because we say the word recession, it's definitely not we're saying the word depression. Recession can be okay. Things do breathe, right? They go up, they go down a little bit, and that doesn't mean that we're going to have some sort of calamity.
Well, and that's the key, right? Is no matter how bad the headlines are, no matter how much the internet screams about all these negative things, growth may slow, but never in the history of the world has it stopped.
Right.
And that's the P.
That's a perfect thing to end on. Man, that's awesome stuff. Thank you very much. Keith Fitz-Gerald coming to us from Seattle. Thanks for being on the show. Welcome back, anyway. All right. Now here's a look at those equity markets that Keith and I talked about. Let's take a look and see what we've got going on with that Dow. Well, it's only down 148. It had been down a lot more. If you look at that low, we're at 31,700 right now. 31,300 was low. So you could have added another 300-400 points to that loss there, and that would have been kind of an ugly day. How about the S&P 500? That's going to be the 500 stocks. That's also off 59 to 57 points in deference to the Dow. The NASDAQ was one that was really struggling early here today, folks. Still is. This is a decent percentage loss here. I think that's going to be around 3%. So that's a tough one. If you take a look at that, 303 points down on that NASDAQ. That's the tech-heavy sector. This is the mid-caps, the Russell 2000. They're off between, say, 38 and 39 points as all the other indices are. Okay. We talk so much about the fuel crisis driving our inflation right now, and it seems like the solution is so easy, doesn't it? So why is there talk of tapping into yet another strategic reserve? And I bet this is one you've never even heard about. I'll break it all down when the Cow Guy Close returns.